7 years ago, Mr. Miller made his first ETF investment. 41 years old now, high school teacher in Columbus, Ohio, patient investor, deeply uncomfortable with financial complexity. He put $12,000 into VTI, Vanguard's total stock market ETF, set up automatic $300 monthly contributions, and tried his best not to think about it. 7 years later, that portfolio is worth $51,000. That sounds like a success story, and in some ways it is. But here is the number that keeps Mr. Miller up at night. If he had understood 7 specific things before he started investing, that $51,000 would be closer to $74,000 today, a $23,000 difference. Not from picking better funds, not from timing the market perfectly, not from any complex strategy. From 7 behavioral and structural lessons that nobody taught him before he started, that no financial planning content he found ever clearly explained, that he only learned by making the mistakes that cost him $23,000. Today, I am going to give you all 7 lessons in 7 minutes. The ones James learned the hard way, the ones that would have changed his numbers significantly, the ones that nobody talks about because they are boring. And boring, it turns out, is exactly what builds real wealth. Lesson 1. Compounding feels nothing like the chart. Every financial calculator shows you a smooth upward curve. Your money grows, then grows faster, then grows even faster. What the calculator never shows you is what it feels like to live inside that curve. Because compounding is not smooth, it is violent in both directions. In 2022, Mr. Miller watched VTI drop 19.5%. 3 years of patient gains vanished from his screen in 8 months. And here is the detail that destroys investors emotionally. When you are down 20%, you do not need 20% to get back to even. You need 25%. Because the math of losses is asymmetric. Losses hurt more than equivalent gains recover. Mr. Miller almost sold in October 2022. He did not. VTI gained 26% in 2023, then 24% in 2024. The investors who sold during the drawdown missed both recoveries entirely. Lesson 1. Compounding only works if you survive the parts that feel like it is not working. Lesson 2. Dividends are not about income, they are about psychology. For his first 3 years, James ignored dividend ETFs completely. Growth seemed smarter. Why settle for a 3.5% yield when growth funds were returning 20%? Then 2022 happened. His growth-heavy portfolio dropped. The number on the screen got smaller every week, and he had nothing tangible to show for 3 years of patient investing, except a shrinking balance. His colleague David owned SCHD alongside VTI. SCHD dropped too in 2022, but every quarter David received dividend payments, real cash arriving in his account, even while prices were falling. That income kept David psychologically anchored. He did not panic sell. He did not feel like he was losing. He felt like he was being paid to wait. Mr. Miller sold nothing, but he understood in 2022 what dividends actually do for an investor. They are not primarily an income strategy. They are a behavioral strategy. Dividend income gives you a reason to hold during the periods when holding feels irrational. SCHD currently yields approximately 3.6% with a 10-year dividend growth rate of 10.6% annually. On a $50,000 position, that is $1,800 per year, arriving regardless of price. That $1,800 is not just income, it is the psychological cost of not panic selling.
Lesson 3. Fees matter over decades, not months. Mr. Miller spent his first year obsessing over expense ratios. VTI at 0.03%, SCHD at 0.06%, DGRO at 0.08%. He calculated the differences obsessively. He avoided any fund above 0.10%. Here is what he missed. The difference between 0.03% and 0.08% on a $50,000 portfolio is $25 per year. The difference between investing and not investing while waiting to find the perfect low-cost fund is everything. The honest lesson on fees. Below 0.20%, the differences are negligible for most investors. Above 0.50%, start paying attention. Above 1%, walk away. Do not let fee obsession become analysis paralysis. The cost of not investing while you optimize fees is always larger than the fees themselves.
Lesson 4. Dollar cost averaging is behavioral, not mathematical. Every explanation of dollar cost averaging focuses on the math. Invest regularly and you buy more shares when prices are low. Your average cost per share decreases over time. Textbook explanation. Mathematically sound. But after 7 years, James knows the real reason dollar cost averaging works. It removes the decision. When Mr. Miller set up automatic $300 monthly contributions, he stopped asking whether now was a good time to invest. There was no now. There was just the 15th of every month. No decision. No hesitation. No waiting for a better entry point that never arrives. Mr. Miller tracked how many times he delayed a lump sum investment because the market felt too high. 11 times in 7 years. Every single delayed investment would have been worth more if made immediately. The best time to invest is always the moment you have money to invest. Dollar cost averaging does not just smooth your cost basis. It removes the human judgment that consistently costs investors money. Lesson 5. Diversification is not the same as owning more funds. In year 3, Mr. Miller owned 17 ETFs, a total market fund, a technology sector fund, 3 international funds, a real estate fund, 2 bond funds, a small cap value fund, a dividend growth fund. He felt diversified. Then he ran an overlap analysis. VTI alone holds over 3,500 US stocks. 7 of his other funds held positions that were already inside VTI. He was paying 7 separate expense ratios for minor percentage tilts on top of exposure he already had. More funds is not more diversification. It is more complexity with diminishing returns. Mr. Miller sold 11 positions, kept VTI as his core, added SCHD for dividend income and value tilt, added a small international allocation for genuine geographic diversification. His returns did not suffer. His stress levels dropped dramatically. His fee burden decreased. Simplicity is not a compromise. It is the strategy.
Lesson 6. Your portfolio is only as strong as your emergency fund. This is the lesson Mr. Miller paid for directly. In 2021, his car needed a $4,200 repair. His emergency fund was underfunded. He needed cash immediately. His only liquid option was his investment portfolio. VTI was up significantly that year. He sold shares at a gain. He paid capital gains tax on the sale. He got the money he needed, but he also triggered a tax event on appreciated shares he had planned to hold for decades. And he removed shares from his portfolio during a period of strong compounding. The estimated long-term cost of that sale, based on what those shares would have grown to over the following 3 years, approximately $8,400. A $4,200 car repair cost Mr. Miller $8,400 in future portfolio value because his emergency fund was not adequate. Your investment portfolio is long-term capital. It compounds most powerfully when it is never touched. That only happens when every short-term financial need is covered by accessible cash outside the portfolio. 6 months of expenses in a high-yield savings account is not conservative financial advice. It is the infrastructure that allows compounding to work.
Lesson 7. Checking your portfolio less is an investment strategy. In year 1, Mr. Miller checked his portfolio every day, sometimes multiple times per day. Every red number felt like a personal failure. Every green number tempted premature celebration. He made 14 unnecessary trades in his first 2 years. 12 of them reduced his long-term returns. Then he changed one habit. He checked his portfolio once a month, then once a quarter. The volatility did not change. His emotional response to it did. When you check daily, a 3% drop feels catastrophic. When you check quarterly, that same 3% drop is invisible inside a bigger positive trend. Less information produced better decisions. The data on this is consistent across every study that has examined investor behavior. Investors who check portfolios infrequently trade less frequently. Less trading means lower costs, fewer tax events, and fewer emotional decisions made at exactly the wrong moment. Checking your portfolio less is not laziness. It is discipline in a different form.
Mr. Miller has $51,000 after 7 years. If he had understood these 7 lessons from day 1, his estimate is $74,000. That $23,000 gap came entirely from behavior, not fund selection, not market timing, behavior. The 7 lessons in order of impact. 1. Survive the down years. Compounding only works if you stay invested. 2. Own dividends for psychology, not just income. 3. Fees matter at extremes, not at basis points. 4. Automate everything to remove human judgment. 5. Own fewer funds with genuine diversification, not more with overlap. 6. Build your emergency fund before your investment portfolio. 7. Check your portfolio less to make better decisions. None of these are complex. All of them are difficult. The gap between knowing what to do and consistently doing it is where most investors lose their returns. Pick the one lesson from this list that you are currently not following. Just one. Make one specific change this week to address it. Post in the comments which lesson it is. Just the number, 1 through 7. Because the investor who identifies their single biggest behavioral gap and fixes it this week will outperform the investor who studies 10 more videos and changes nothing. If these lessons changed how you think about your own investment approach, subscribe to this channel. Next week, we are revealing exactly how to build a 3 ETF portfolio that covers every job your investment portfolio needs to do for under 5 minutes of management per month. Subscribe, hit the notification bell,
and share this with someone who just started investing and has 7 years of costly lessons ahead of them. Unless they watch this first. See you next week.